Hey everyone, welcome back. So today I'd like to talk about a stock that I own called Scorpio Tankers because in my quest to learn in public and discuss things that I've bought and sold so that I don't have something called thesis drift. I think this is a good stock to illustrate a concept called operating leverage. So operating leverage works in the same way that financial leverage would, where you're increasing your return, except that the operating leverage is based on the business model, not on borrowed money. So if you bought a house and say it was $100,000 and you put 10% down, and the house went up 10%. Now your house is $110,000, but your equity, the money you put in, goes from 10,000 to 20,000. So the house went up 10%, but you made 100%. So that's financial leverage, and it works that way because you have borrowed money. And with operating leverage, your returns increase as income goes up, but in a disproportionate way, but it's due to the way the business operates. And you'll see this a lot in things like airlines and drug companies and things like that. So with an airline, once you sell the first half of the seats, the second half is a pure profit. And same thing with the drug company. It takes about $100 million, say, to develop a new drug. And once you've recovered that cost, each pill, costs pennies to make, and you sell it for dollars. So it becomes very profitable. And operating leverage is kind of hard to understand because, it's counterintuitive that, something would go up 10% in sales, but, you would make 30 or 40% more money. And another counterintuitive thing is that in companies that have a lot of operating leverage, and a lot of them are energy companies, generally the guy who makes the most money is the worst company. So it's sort of like Bizarro Superman, where, when he says goodbye, he means hello. And, he's not, kryptonite doesn't hurt him, so it's like everything's backward when it comes to operating leverage. So the way to think about this, let's say that you and I have a product that we make, and you're better at producing it than I am. We both sell 100% of our inventory, and this thing sells for $10, but costs you $5 to produce, and it costs me $9 to produce. So I make $1 for every $10 that comes in, and you make $5 for every $10 of sales that you. Now something happens, and now you can sell the product for $11. So I now make a product for $9. I sell it for $11. I go from making $1 to $2. You are a much better operator than I am. You make it for $5, and instead of selling it for $10, now you sell it for $11. So we both make an extra dollar, but in terms of percentages, my income doubled. I went from making $1 to $2. That's 100% increase, and you went from making $5 to $6. So your income only went up 20%. So that's kind of a weird example, but in operating leverage, like I said, the worst operator tends to make more money when things go up. And the flip side of that is the better operator is probably the one who's going to survive in a downturn. So if there's a lot of people making this product for $10 and demand goes down, people start selling it for $8, start selling it for $7. I can't compete. I may go out of business, and you're still selling it for $5. So you can make money no matter what happens. And generally in something like, companies that produce a commodity like energy, you don't want to be foolish about it. So if produce it for $9 and you produce it for $5, you don't want to sell all you can for $6, because, even though you'll run me out of business, you're leaving money on the table. So if we're both selling all we can, you're better off keeping the price at 10, and we both stay in business, both sell 100%. You just want to keep the price at where you sell 100% of yours, and you don't worry about the competitor. But you definitely don't want to drop the price too much, because if you're at 100% production at $10, why would you drop it to $7? So that's basically operating leverage in a nutshell. And then we'll go over shipping in general, and then this company that I own specifically. So shipping is kind of a weird thing to understand because you might know somebody who's in real estate, or you might know somebody who is a computer programmer, but you probably don't know anyone who's in shipping, so you don't have anyone that you can ask questions about. A good place to get started. There's a couple of books, The Shipping Man and Viking Raid. They're by Matthew McCleary, who's a hedge fund guy who runs a newsletter for the industry. And he wrote several novels about this fictional character who is a hedge fund guy who gets involved in the shipping industry. And through the novels and the mistakes that this guy makes, you'll learn a lot about the shipping industry. So that's a good place to start. I also read a textbook called The Business of Shipping, which was okay. And then another book called Empires of the Sea or something like that, where it had different profiles of different people in the industry. So that's a good place to get started. And the place that a lot of people recommend, and it's actually wonderful, is this book called Maritime Economics. And it sort of like separates the dabblers from the professionals. So just like Security Analysis by Ben Graham is what you would want to read if you're a serious practitioner versus the people who dabble in investing in stocks. This sort of separates the people who are amateurs from professionals. It's a lot longer than the other books, but it's very well done. It's on the third edition, and because I'm a value investor, I looked at the hard copy of the third edition was $200, the soft copy was $100, but I found the second edition for only $10. So this is Maritime Economics by Stopford. It's a great book, very thorough, and a lot of detail. It's about 700 pages for the new edition. So it's not a light read, but you'll learn everything you ever wanted to know about shipping but were afraid to ask. So anyway, I'll start with the disclaimers. This is for entertainment and educational purposes only. I'm not a financial advisor. I don't give financial advice. I'm not saying to buy or sell this stock. I do own it, and I'm recording my thoughts on it and why I own it, so that if things change, I don't succumb to thesis drift. I'll have a contemporaneous account of why I invested in it. And generally, for most of the stocks I own, I print out a little one-page thing, and from Value Line, and I write on the back of it why I invested in it. And I don't think this one was on Value Line because it's not an American stock; it's based in Monaco. But I do have my notes of why I invested in it. And so the first thing you need to understand about the shipping industry, there's different ships do different things. Container ships take those big boxes full of stuff from China to the US. There's things called bulk carriers, which there's a lot more bulk carriers than the other kind of ships because they transport things that are low price but very bulky. So things like coal and iron ore and things like that. These are bulk carriers. So dollar wise, shipping containers ship the most, but raw numbers wise, dry bulk tankers are the most. And then you have the things that transport the wet stuff, petroleum. So in that you have the crude carriers and the product tankers. So dirty and clean. So the stuff comes out of the ground, they put it in a VLCC, very large crude carrier, or something a little smaller if depending on the port. And from there it goes to the refinery. The refinery takes the oil, turns it into gasoline, naphtha, benzene, butane, whatever. And then that stuff goes into something called a clean carrier or a product tanker, which has a bunch of different compartments. And this is from Maritime Economics. And it's sort of, as you can see, there's a bunch of different compartments for it to transport the different liquids, and they have special epoxy coating. And these things are smaller than the big oil tankers, but they carry different things to their final destination. And yeah, they don't last as long as some of the other things, but ships, every few years, they have to have something called a special survey, sort of like when you take your car in for its 100,000-mile check and they replace the timing belt. With ships, after every few years, they have to do a certain number of things to it. And with product tankers, generally 15 years is when you stop using it as a product tanker, because at that point, the special survey that you do, you have to put new epoxy coatings on everything, and it's very expensive. So generally at that time, either you go scrap it or if people are still getting good prices for the dirty tankers, you might turn it into a dirty tanker for a while and run it for a little bit before you scrap it. And then you scrap it. So with the shipping industry, it's very cyclical, just like the real estate industry. With commercial buildings, people make money, they build more buildings than you should, then there's a crash, and they don't build anything for a few years, and then the cycle repeats. And the same thing with shipping. So right before the great financial crisis in 2008, there was a lot of people that built too many ships. Then the great financial crisis happened. A lot of people went bankrupt. A lot of people lost their shirt. Nobody made money for another 10 years. And the cycle repeats. So during the lockdown in 2020, there was a shortage or disruption of stuff coming out of China. So a lot more people were ordering container ships, which are the ones that carry the big boxes. And with a container ship, when you get them built, think about when you take your car to the mechanic, you've got those lifts, and you can put my car on it or you can put your car on it. You can't do both. So if everyone is building these container ships, a lot of orders came in 2020, and it takes 3 years to build a ship. If you're building a lot of those ships, you probably aren't building a lot of dry bulk carriers. You're probably not building a lot of oil tankers. You're probably not building a lot of product tankers. So as those ships hit the water and these other ships are and nearing the end of their useful life, there might be a shortage, and then the price can inflect and you can make a lot of money. That's the theory. There's a couple of things that are sort of helping that hypothesis along. And hold on one second. So the thing with a lot of commodity companies that are cyclical is a lot of times they won't make money for 10 years, and then all of a sudden 1 year they'll make 10 years worth of income in 1 year. So you sort of, a lot of times will buy too early and you'll be waiting. And if you can time it right, you'll make a lot of money. But a lot of times, you'll just be waiting and waiting and waiting and give up hope, and then you sell it and then it goes up. So be patient and look for things, catalysts are going to turn the tide. So as I mentioned, in 2008, prior to the great financial crisis, people were building way too many ships. And a lot of times shipbuilding is subsidized by governments of Korea or China or Japan, because it employs a lot of people. So sometimes they produce them uneconomically because they want to keep people employed. And so, too many ships are produced. And after the great financial crisis, a lot of financial institutions got into trouble. So there's an international organization called that's based in Basel, and they put out these standards that other international regulators look to for the banking standards. So, they call the Basel Accords, Basel II, Basel III. I think they're up to Basel IV now. But anyway, the latest one, they changed their standards to make it harder to lend on assets like ships. So basically, banks and other financial institutions have to have a certain amount of capital on their balance sheet. And when you have something like cash or government bonds, those are rated 100% on the dollar. They don't get a haircut. But other things get bigger and bigger haircuts, and the things that are illiquid assets like ships now get bigger haircuts. So a lot of banks don't want to lend on these. So you've got this issue where banks don't want to lend on these, and they haven't made money for 10 years. So a lot of hedge fund guys that got into this prior to 2008 have no interest in this. So it looks like the supply side is lighter than it should be. And what about the demand side? Well, there's also this international organization called the International Maritime Organization that sets standards for these ships. And something that came out, and it's called IMO 2020, in an effort to reduce pollution, where they wanted ships to burn cleaner. So when you put petroleum through a refinery, and it breaks it into different things. You've got the high stuff like butane on the top, and then as you go lower, gasoline, heating oil, jet fuel, and then at the very bottom, the crud that's at the bottom, they use that for asphalt, and right above that crud is what they use for ship fuel. They call it bunkers, and it's very bad, has high sulfur content. And so the IMO 2020 standards, which came to effect in 2020, said that you had two options. You either had to use a low sulfur fuel, or you had to install these scrubbers, which are several $1,000,000 on your ship. So if you're a ship owner faced with these options, if you have a newer ship, you would probably install the scrubbers, because rather than paying for the more expensive fuel, you can still use the cheap fuel, and you're just putting it to a scrubber. And if you've got a long life on the ship, you can make up that money over time, because your cost to operate will be a little lower than the guy who's paying more for the fuel. And if you have an older ship, you're not going to pay millions of dollars to put the scrubber on when you've only got a few more years of life on your ship. So you're going to pay to use the cleaner fuel, but your operating costs are higher, which is going to eat into your profit. So um, Scorpio Tankers, Sting has the newer fleet among the shipping operators. Sorry, clean product tankers operators. So they got over 100 ships, and 85% of them have the scrubbers, so that gives them this little cost advantage. Uh, Sort of what threw a monkey wrench into this was during the lockdown in 2020, when nobody was driving, nobody was flying, the whole world was shut down. Obviously, nobody was using these product tankers. And actually, the price of petroleum went negative. It went negative like $34 a barrel. And you would think like, well, how could the price of oil be negative? Wouldn't you just say, okay, I'll take it. It's negative $30, and I'll just sell it. But you had no place to put it. So, it was coming into these refineries. Refineries couldn't make the gas and everything because nobody was driving. So nobody wanted the petroleum, and people were running out of places to store it. So a lot of the crude carriers that were used to ship crude back and forth were just turned into floating storage. And some of the older clean tankers were temporarily used for floating storage because the price was so high uh, for storage. And I mentioned clean tankers and dirty tankers. You can go from clean to dirty, but you can't go from dirty to clean because that would involve rehabbing the ship. So at the end of the useful life for a lot of these product tankers, they run them dirty for a few years or for a few trips before they scrap them. But a lot of the older ones were used for storage, so that sort of came taken out of the fleet. And now the number of clean tankers you have has gone down. Then we have the war in Ukraine and sanctions against Russia. So oil is being rerouted to different places. And if you are shipping oil, if you're shipping products like gasoline from one place to another, and you have certain routes, they're probably the most efficient routes. And now that you have to shift them, you're going to use less efficient routes because you're shipping them different places. So that adds to the number of miles that you're traveling. And when you do that, if there's more miles traveled, that's effectively means there's fewer ships available. So the price for these assets that they're getting on each trip goes up. And as I said, in 2020, there were a lot of people putting in orders for container ships. So there's ships being built that aren't these ships. So these ships are being scrapped at a faster rate than they're being replaced. And even if the prices were really high now and people said, let's order more product tankers, you wouldn't get them for 3 years. So that's all lining up to make things very favorable. And let me see. So when things like the lockdown in China or war in Ukraine happen, these things tend to benefit from that. So it's almost like having an option on volatility or disruption in the world, which seems to be going up lately. So let me pull up the screen and we'll share something here. So this is the time charter equivalent rate for Scorpio Tankers. This is from their investor presentation. So as you can see, right before the lockdown, they were getting a lot of money. Then the lockdown happened. People weren't driving, people weren't flying. It went from 20 or $30,000 a day on average for their fleet to 10 or 11,000. But now that the shortage seems to be working in their favor, it's gone up to 36,000, 45,000. and we're currently at about 39. So right around this part, Q4 2022, they were getting around $50,000 a day, and they thought that would continue, and it didn't. So it looks like around there, the price started dropping off, and it went from in the 60s to in the 40s, and that's where it currently is now, in the 40s. In the 40s, it's about a 2.4 billion market cap. Doesn't have a ton of debt, but something to consider with this is that, let me pull up the thing here. So this is from Yahoo Finance, and you can see it's a $2.5 billion company, and a couple of interesting things. One, if you look at the EV to EBITDA, it's as low as it's ever been. It's as low as it's ever been. Usually, I like to see something below 10. This is 3, which is incredible, and the forward PE of 3, that almost looks like an error. But if we go to the investor presentation on their website, you could see that it's actually not an error. So initially, around this time, Q4 2022, they thought they would get about $50,000 a day, but they didn't. The price dropped now, as you can see, currently about $39,000 a day, right? So at $40,000 a day, it's still not a bad setup. You're getting almost $20 a share in income profit from these rates. So that's the operating leverage coming in. So, if you're $20,000 a day, you get about 5.7 a share in income. And at $40,000 a day, which is twice as much, you're getting nearly $20 a share in income. So $20 a share in income, and the price is selling for 45. That's about 2.5 PE. That seems incredible. No guarantee that prices will go higher or even stay where there is. They might go down, but it doesn't look like that because, as I said, this fleet is pretty old. As the ships get scrapped, makes the existing ships more valuable. Scorpio Tankers has the youngest fleet, and so they have more time to let this thing play out. And because most of their ships have scrubbers on them, they sort of can take advantage of this differential between the low sulfur fuel and the high sulfur fuel. And another thing to think about is they've also been so profitable that they're buying back a lot of shares. So this is about a $2.5 billion company at this price. Last year, they authorized a $250 million buyback. They blew through that, and at an average price of around $50 a share. And this quarter, a few days ago, they authorized another $250 million. So 250 plus 250, that's $500 million. This is a $2.5 billion company. So if the prices stay where they are, they can buy back 20% of the shares of the company at an incredible price just this year. And stock buybacks, if you do them at the right price, are very accretive to shareholders. If you do them at the wrong price, they're not. But it's hard to argue that when you're making $20 a share, buying back the shares at $45 or $48 is a bad deal. And as I mentioned, the order book for new tankers is a lot less than what is needed to replace the current fleet. And as things happen in the world that cause disruption with the shipping lanes, the war in Ukraine, rolling lockdowns in China, any disruption that happens with Iran or Venezuela or anything like that, that all benefits these product tankers, because as you move ships around, the shipping distances get longer, which means you effectively have fewer ships, and that helps the rates that you charge for this. A couple of smart things they did. They've been paying down a lot of the debt, so you can get more money in the spot market than you can renting these ships long term. But the problem is that if you rent them short term instead of long term, if there's a downturn and you have a lot of debt, you might go under. But they've been very responsible in paying down debt first and then shipping assets from the long-term market to the spot market and making more money at them. Two, the buybacks are incredible. 500 million combined last quarter and this quarter. That's a lot of stock you're buying back when it's a $2.5 billion company. And they're making so much money, they can afford to buy back 20% of the shares, pay a dividend, and pay down debt all at the same time. So I like the setup here. No guarantee that it's going to play out like I think, because shipping companies generally are terrible businesses, and they're trading sardines. You don't want to hold them long term, but if you time them right, they can work well in your favor. Things that could hurt this if there is a recession or another lockdown or anything like that, where for an extended period of time where people aren't driving, they're not flying, then there's less demand for these product tankers, and that would obviously drive the price that you get for these down. And if that stays down for long enough, obviously that's bad. Or if things are higher or slightly higher than normal, but for a long period of time, then it might tempt people to invest in this business. And then if people start buying product tankers, then 3 years from that date, a lot of them won't hit the water, and then prices will go down. Another thing to think about is management in the shipping business. A lot of the management is very opportunistic, and they have very sharp elbows, and they tend not to be very concerned about what shareholders think. As I said, trading sardines, the people in this industry aren't generally like Warren Buffett, where they're very shareholder friendly and care about you and want you to succeed. Generally, they're in this business to get rich. So, that's my thoughts on this and on operating leverage. And once you see operating leverage and understand it, you'll see it in a lot of other places. So, this is a shipping company that benefits from operating leverage, but as I said, you'll see this in airlines, you'll see this in software companies, you'll see this in a lot of commodity companies. So just in terms of pattern recognition, where you see an industry where it has high fixed cost, and that a lot of the time will be something that benefits from operating leverage. So to differentiate that, let's say that you're an auto manufacturer and you make cars for $50,000, you make $10,000 on each car. If your sales go up 10%, you make 10% more profit. But as I said, with these operating leverage companies, if you're a gold miner, generally you produce a certain amount of gold, and you pull that same amount out every year. And if price of gold goes up, you make a lot more. Price of gold goes down, you lose a lot more. And so the price of gold goes up 10%, you might make 30 or 40% more. And with software companies, once you've paid the cost of the software, each additional person that uses your software, it's essentially free, so it's all profit. And that can work against you. Also, it's a double-edged sword. So recently, Bill Ackman bought a bunch of Netflix and then sold it, very quickly after, when their subscriber growth reduced, because operating leverage works wonderfully when it's going up, but it's pretty brutal on the way down. And he recognized that early, and then he sold it, and then the stock got cut in half, and it's recovered since then. But that's again another industry that benefits from operating leverage, and it's just one of those pattern recognition things that you want to look out for. So hope you like this, and there's a couple of other ones I want to do on this. There's a company that is run by the same people that run Scorpio Tankers that I own some of, called Anetti, and that's a pretty interesting company, and maybe I'll do that. But if you have any questions on this or on operating leverage in general, just put it in the comments. And if there's something else you want to see, just leave a suggestion. So once again, this is for entertainment purposes. I'm not a professional. I'm an individual investor just like you, and I'm doing this to learn for myself in public. And my goal for this long term is just to have something to refer back to, and hopefully, who knows, maybe one day I'll be at one of these companies. I would love in a perfect world to be a director of a public company. And maybe if this thing takes off, people will realize, uh, I have some useful things to provide, and we'll see where that goes. But anyway, for now, I love my day job, and this isn't part of my day job. This is just something I do for fun. And hopefully, if you're doing this for fun too, you're getting something out of it and learning from it. So like and subscribe. And as I said, any questions, just leave them below. And we'll see you next time.